So welcome to the Introduction to Technical Analysis webinar. My name is Zoe Fides and I work in the EasyForex London offices. If you're watching this as a live webinar, then via the doc that you see on your screen, you can ask questions at any point, and I'll do my best to answer all of these. If you're not watching this as a live webinar and you're watching it as a recording, which will be available after 1 hour, then you can send questions to uktraining@easy-forex.com. That's uktraining@easy-forex.com. Now, before I begin, I have to tell you that anything I present today cannot be taken as advice. It is for educational purposes only. So what you should see on your screens here is the MT4 or MetaTrader 4 platform. This is just one of the platforms we have, and the charting software is very good on this. We also have good charts available on our website platform as well. So let me start by explaining what technical analysis is and what it's used for. It is the use of charts and charting indicators to study the behavior patterns of market crowds. Remember, each tick of the price you see is actually the consensus of the market crowd and where that crowd believe that one currency should be priced against another. Hence, the chart is giving you an image of this consensus. And through technical analysis and looking at these charts, as well as using indicators that can be placed on these charts, we get an image of what this crowd consensus is doing over time. What we're searching for is patterns, and we're looking for history repeating itself. So let's start by just looking at a very basic chart, the line chart. So each time the price ticks, we're given a new dot on the line chart, a very, very basic chart that I'm sure you are all very familiar with. Although this is useful to some length, actually traders use what we call bar charts or candlestick charts to get more information about what the price is doing. We also have the choice of looking at the time period. So for example, if we just wanted to know what happened in this price, which is sterling versus US dollar, what has happened in the short term, so in the last hour or so, we would go to what we call a 1-minute chart, which is M1. And we can see the most recent movements in this pair. But if we wanted a bigger picture, we could look at the daily chart. And you can see that we've got information going all the way back to October 2010 here. So when we're analyzing these patterns, we have the choice of the range that we're looking at. So let me take you to a bar chart now, and I'll zoom in. You can see that this looks very different from a line chart. We've gone from having a dot on the line and all the dots linking to create this line to now having these bars. Each bar, you'll see, has small horizontal lines coming on the left and the right. This is giving us information about the price. First of all, depending on the time period you're looking at, each bar represents that time period. So because we're looking at the daily chart, it means each of these bars represent 1 day's worth of price movement. The higher of the bar is the highest price of that day. The lower of the bar is the lowest price. And the small horizontal lines you see coming off the vertical are the open price and the close price of that day. And of course, I can look at different time frames. So if I now were to move it to an H1 1-hour chart, bar chart, each of these bars now represent 1 hour's worth of price movement. So, obviously, 24 of these bars make up 1 day. So what it's effectively doing, if I look at my daily bar chart again, it means that one of these bars can be broken down into 24 bars. And we're getting a closer look of what's happening. It's like taking a magnifying glass and looking at the price pattern more closely. And I can take it all the way down to 1 minute if I wish. Now, obviously, the range, so how much the price moves, and the volatility, is going to be much larger when you're looking at a day chart compared to when you're looking at a 1 minute, 5 minute, 15 minute, the smaller ranges, smaller time periods. So the bar chart is a very popular chart to use. It's giving us more information about the price. It's telling us the high and the low in the time periods that we're looking at. Also, it's telling us the open and the close. This is all valuable information to a trader. The next step up from this, and also a very extremely popular chart, is the candlestick. So you can see here, these are the bars, and these are the candlesticks. So candlesticks are very similar to bars, but candlesticks is giving us even more information about the price. We've still got our high and low, represented by the body of the candlestick. So if I zoom in, you can see that a candlestick has a body and has a wick above and below. The body of the candlestick represents the difference between the open and the close price. So the open and the close before was represented by these two small horizontal bars. Now this has filled in and become a body. And the wicks above and below represent the highest point and the lowest point in that particular time period. Now, to add to this, and what we weren't getting from the bars, is a color. The color of the candlesticks indicate to us whether that candlestick closed higher or closed lower. On this chart, a candlestick that closed lower, which means that the price closed lower in that time period, is white, whilst a candlestick that closed higher is black. So now we've got a chart. We've gone from having a line chart, which gives us only very basic information, to now using a candlestick chart, which is giving us a lot more information about what the price is doing. Hence why these charts are very popular to use. And it's good for you, as someone that's looking to trade or is trading at the moment, to get used to these candlestick charts. So to begin with, I'm going to be focusing on patterns in price movement. This is where you should start when you start using technical analysis. It's a building block to then go on to add indicators. But you must start at the beginning and you must understand everything that you're looking at. Now when you're trading, the price is going to be doing different things in different environments. Hence you need to be adaptable. It's not often you can use one strategy 24 hours a day, because the price is either going to be in a trend, so moving up or moving down. It's going to be in a range where it's hitting a top ceiling and coming back down to a floor before it moves up again. Obviously it can be in a trend within a range, or it'll be trading sideways. By sideways, I mean the price isn't really going anywhere. There isn't much liquidity, trades going through the market, or the market are undecided on which direction they want to take next. And the price can move in a sideways direction. Now you as a trader, using your charts, can identify what phase the price is in. Is it in a downtrend or an uptrend? Is it in a range? If it's in a range, where are my turning points? Or is it in a trend within a range? Or is it simply doing nothing and it's just trading sideways? This is the first thing that you need to identify by looking at your chart. Once you've identified that, then you know which strategy you can go on to use. So let's start by looking at one of my favorite currency pairs, which is Australian to US dollar. It's been very interesting lately because it's a pair that's moved above parity, so the one level. And then recently, the Australian dollar has weakened hugely and it's recently moved back below one again. So let's just take a look at this pair on a larger scale. This is my daily candlestick chart. So remember, each of these candlesticks that we're looking at here represent 1 day's worth of price movement. Okay, we can see that at the beginning of this year, the pair was moving up. And it came up to challenge these highs, which we can see here was around 1.0845. And it stayed around this area for some time, for almost 1 month in fact, attempting to challenge this top side zone over 1, 2, 3, 4, 5, 6, 7 days. But it was unable to move any higher. So this is acting as a ceiling to the price, and it turns out it was a strong turning point. And you can see since the 1st of March, the pair has been in a strong decline, a downtrend. Recently, we've hit a low. At around 95.80. This is a significant low, and the reason being is because you can see it's managed to turn the price back up above a previous high. So this level here has quite some significance in the market now. The whole market can see that the price came down to this low and pushed the price back up. So you can see what I'm doing here. I'm starting by looking at a daily candlestick chart to get my bigger picture. Now, of course, if I'm day trading, short-term trading, and I'm only looking to be in a trade for an hour, a couple of hours, or maybe a day, then I won't be using my daily candlestick chart to trade off, simply because the range is too large. I'm not getting any specific entrance or exit points. But what I can do is zoom in by looking at a smaller time period. So now this is the 4-hour candlestick chart. And by clicking on that, now each of these candles are worth 4 hours of price movement. So effectively 6 of them in a row is 24 hours, 1 day. So I'm breaking the day movement I saw in a daily candlestick chart down into 6, and I'm seeing more information. First of all, I can see that the price has zigzagged down nicely with lower highs and lower lows, which is an indication of my downtrend. Then I can see the absolute low here again, as we could on a daily chart, and I can see how this rebound has actually gone through the previous high here. So this low is very significant. Now I'm going to look at a 1 hour. So now I'm breaking each of these bars into 4, going from my 4-hour candlesticks down to a 1 hour. So I'm getting a lot more information about what's happened recently. Now let me stay on this 1-hour chart because something quite interesting is happening here. We can see that off the low that I was referring to before, the price has moved up nicely. And it reached a high. It reached a high before turning back down strongly, moving below previous lows, and came to a new low. Okay, before it reversed and started coming back up again. Now if you look at this level here, this high was made around 1. This is a very significant level, parity, where the price of the Aussie dollar equals the US dollar. It's significant because it holds psychological significance in the market crowd. Imagine if you had been a buyer of Australian dollar to US dollar, and you had been used to buying in the 96s and 97s and 98s, even the 99s. When the Aussie to US dollar price reached 1, buyers became reluctant to buy above 1, because buying at 0.99 or 0.9950 feels like a much cheaper rate than buying above 1. So what's going on at this level here is market psychology. The buyers are reluctant to buy above 1, but on the other side, the sellers are very happy to sell at this level because it's a high price, and they know that it bears a lot of significance, and they know that the market are going to be reluctant to go above the 1 level. So that combination where the buyers will not buy at this price, they'll only buy at a cheaper rate, and the sellers are happy to sell at a cheaper rate, causes this movement downwards. So what we would do, as someone looking at this chart, bear in mind we would have only been able to see this at this point, we would have added this level onto our chart, waiting to see what happens when the price comes back up. When the price returns to this level and struggles to move above it, that can be an indication for us to sell. Because what's happened here is what we call a resistance level. A resistance level is where the price finds it hard to move from below to above that level. It's a ceiling to the price. Now what traders do and what technical analysts do is they look to see the price behavior around that resistance level. And if the price looks as though it's not going to pass through, then they sell. And you can see how in this example, the price has come right off that parity level. So we've got a resistance level around 1. Let me move on to another example. This is the US dollar versus the Canadian dollar chart. I'm still on my 1 hour time period, which means each of these candlesticks give me 1 hour of price movement. You can see that the pair was strongly moving down. It reached an absolute low here, which was around 1.0210, before moving sharply back up again. This is a significant rebound because it's moved above previous highs before it fell again. So this happened on the 7th of June. Now the price has come back down to this level, and you can see what's happened. The price came back down to this level and has moved back up again. This level holds significance in the market. Sellers are not willing to sell below this level, but buyers are very happy to buy and even pay even more for the US dollar versus Canadian dollar here. Hence, the price has moved back up again. So this is what we call an area of support. An area of the price where the price finds it hard to move from above to below. And if you're looking for supports and you're looking for turning point levels, you could use this as an indication to buy. Now, the interesting thing that's happening here, and something that you should be aware of when we're talking about support or resistance levels, is that the level is never an exact price, because it's quite rare for the price to exactly hit one point and turn and then come back and hit that point again at exactly the same price and turn. Obviously, there's going to be a little bit of movement around that level. So it's always best when you're looking at resistance or support levels to actually consider them as a zone. For example, you can see it came to a low of 1.0210 here, but it got down to as low as 1.0201 here. So we've got about 10 pips. So allow that when you're trading. Consider a zone rather than an area. Okay, so I've just shown you two examples. I've shown you the resistance on the Australian to US dollar chart, which is what we'll call a ceiling, an area or level in the price where the price finds it hard to move above. And I've shown you the support, which is an area or a level in the price where the price finds it hard to move below. And what we're doing is we're looking at the moment for sell opportunities at a resistance level, so effectively selling at a high where the price has previously turned lower, or we're looking to buy at a nearer support, so effectively we're looking to buy at a low where we've seen the price turn and move higher before. So we're using historical patterns to indicate where we should be buying and selling. Let me provide you with some more examples. Okay, so sterling to US dollar. Zooming in slightly here. This is the 4-hour chart, so we're seeing quite a big picture what's going on. Let me just zoom in to the 1 hour. Okay, so we have quite a recent example here. We can see that on the 7th of June, the price quite rapidly moved up. So you can see in that hour, the price moved over some distance, very, very long candlestick body. And it reached highs of 156.01 before turning sharply back down. This is obviously an extremely significant level, 156.01, or I could just say 156. What you'll often find is that turning points can occur around what we call big figures. The big figures are 156.00 or 155.00 or 157.00, or the parity level that I talked about in Australian to US dollar, 1.000. It's where the price is turning from, for example, 155.99 to 156.00. That 156.00 is what we call a big figure and holds psychological importance in the market crowd. Again, for the same reasons as Aussie dollar won't go above 1 for now, when the price sharply rose to 156, obviously the market became saturated of buyers at this point. Buyers were not prepared to pay more than 156 for sterling against the US dollar, but sellers were very happy to sell below this and even lower. So this combination is forcing the price, squeezing the price back down. Now you can see that the price then attempted to come back up towards this level and reached 155.80, around 155.80. Okay, so just 20 pips short of our previous high, the price turns again. This is not a coincidence. Obviously, when the price returned back to this high, the market are very aware of what's happened last time. So people become reluctant to buy up here, and we're getting the same impact. So now, what we're left with, which we've identified with two highs, is an area of resistance between 155.80 and 156. It's a zone in the price where the price will find it hard to move above here. So next time our price returns to this zone that we've drawn on our chart, we will be on the back foot to look for a sell opportunity. So let me provide you with another example. Okay, so now I'm looking at sterling dollar still, but it's a 15-minute candlestick chart. So now each of these candles are giving me 15 minutes worth of price movement. So obviously 4 of these fit into 1 hour. So I'm zooming in even closer at the price action. And you can see now I'm only looking at the price action over the last 2 days because it's being broken down into smaller fractions. Okay, so I can see here that I've got a low. This is yesterday's low, which happened yesterday evening. Overnight, the price then staggered slowly back up again. And then at 6:15 GMT, so 7:15 UK time, when the London traders come in and activity starts to heighten again, bear in mind that the London session, which starts about 6 GMT, is where 50% of the Forex volume goes through the market. So that's $2 trillion a day on average. So you quite often get moves around this time. You can see as the London traders came back in, they forced the price back down to almost reach the low that was reached the evening before shooting back up again. So here we have it, evidence of a support level, which has triggered the market to buy at this price and be pushed higher again. And then the third time the price came down to this level, you can see that although it dipped a little lower, so this is around 154.60, this got to 154.54, so just 6 points off of our previous lows. So we're talking about a very, very close level. And you can see the price has shot back up again. So this is a support. It's an area of support that we've identified. And we could have identified this just from these 2 points, presenting our opportunity here to buy. And you can see that the price has moved up fairly significantly, and that would have been a nice trade for today. Okay. I'm just going to provide you with another example on euro dollar. I think the best way to learn about these things that I'm teaching you is to provide you with as many examples as possible. And then it's up to you in your own trading to go and analyze your charts, use the horizontal line function, and mark on these levels. Okay, euro to US dollar. I'm now going to take a look at the 1 hour chart. Euro to US dollar is the most traded Forex pair. So by that, I mean it accounts for most of the volume that goes through the Forex market. I believe it's about 30%, which means it's the most liquid pair, and it means we often get a lot of nice moves in this. Now, obviously, the euro has been going through a bit of trauma recently, or a lot of trauma, actually. And because of that, you can see that the euro has weakened significantly, especially against the US dollar that's regarded as a safe haven currency, which means a time of risk off in the market, when the market are not prepared to take on any risk, the US dollar strengthens, whilst the euro weakens. So that's what we can see here on our daily candlestick chart. But anyway, this is the bigger picture. I'm more interested in what's happening today, and is there anything I can trade off? So just going down to a smaller time frame chart, the 1 hour candlestick chart, okay, I can see what's happened recently in this pair. By the way, this gap here is not an error in the chart, it's actually the gap between the close on Friday to the open on Sunday evening. The FX market opens on Sunday evening, which is Monday morning in Asia, because remember the FX market is 24 hours a day. That opens Monday morning Asia, which is Sunday evening our time, and closes Friday night our time, which is Friday afternoon or early evening in New York. Okay, so this is the gap where the price gapped over the weekend. But anyway, let's go back to studying and seeing what has happened recently in this pair, and can I use history to help me decide what I should do next. We can see here that we've got some significant highs, and actually as the market gapped over the weekend, it came to an even higher high. So we know that these highs will be particularly significant if the price does manage to get back up to this level, 126.25, and we've got 126, around 126.70 here. But let's look to see what's happening on the downside. We can see that this significant low was created around on the 6th of June. You can see that the price sharply moved down in 1 hour, and then the following hour it sharply moved up again. And it continued to move up. Hence, this is a significant low, which is 124.40. In the subsequent days, the price actually returned to this low. And what happened? It reached an absolute low of 124.35, so just 5 points below 124.40, and rebounded back up higher. This holds significance. If we didn't have enough information or missed the opportunity to trade at this point, let's see what's happened more recently. Yesterday evening, the price returned near this low, just 7 points short of the previous low, and has moved back up again. So you can see how these points are forming a support zone, which is an area in price where the price finds it hard to move through. Okay, so I've shown you a fair amount of examples. Let me just answer a few questions now that we have up here. Bear with me for a moment. Okay, so someone is asking me, do I have to find all of these levels myself, or can I get them from anywhere? Well, I think that you as the trader, you do have to have the ability to analyze the chart yourself and find them for your own eyes. But also, you can use this in conjunction with trading signals that are available online. So let me just show you a few of these signals. Okay, if you actually go to the EasyForex website and log into your account, you have free access to streaming trading signals and information. If you haven't traded before, this information can be quite mind-boggling. But with the correct training and practice, you'll be able to quickly digest this information and use it in your trading without it taking up too much time. So, once you've logged in, you go to Research and Analysis section. You then go to Technical Analysis. This provides you with a whole list of technical analysis trading signals, which also give you the support and resistance levels. So what we have just been looking for on our charts is actually giving to us elsewhere. Like I said, you need to use these in conjunction with each other. So let me give you an example. If I wanted to trade dollar CAD, I can go to the dollar CAD link, click on it, and it's giving me some information. Bear in mind this is dollar CAD intraday, so this is for day traders. Saying bullish bias above 1.023. Bullish means that, down to their analysis, they believe that the price is going to move up. When you see the word bearish, it means that they think the price is going to go down. And the best way to remember that is you have bulls in the market, people that believe it's going to go up, and you have bears in the market, people that believe the price is going down. And if you think of a bull, it has horns, and a bull can push its horns up. Whilst a bear has claws, imagine a bear's claws pulling it down. So that's the best way to remember those terms. Okay, so bullish bias above 1.023 for dollar CAD. They think the price is going to move up off that level. Now it gives you some information in words here. It gives you a preference where they think you should buy, and it also gives you an alternative scenario. The best thing to do is actually just to go to the chart, because the chart is visually giving you all this information. You don't actually have to read this. If you are to read this, you can see that their preference at the moment is to go long. Going long means to buy. If you see the word going short, it means to sell. Okay, so they have a preference to go long. And I can see this on the chart because it's indicating an arrow pointing up, indicating a preference to go long, to buy. Now, if you're looking to buy, you then need to consider, where do I want to buy? Well, according to this trading signal, we should be looking to buy around 1.023, which is the blue line here. Now, can you remember when we were looking at the dollar CAD chart, we identified a support zone around 1.0210 to 1.0200. So this is our own analysis, whilst this is from a third-party technical analysis expert. So combining our own analysis with the signal, you can see that our analysis is actually the same as another party. So it gives us the confidence that we're doing the right thing. So now, if dollar CAD falls into this zone, 1.0230, or down to 1.02, the 30-point zone here, I'd be looking for a buy opportunity. Now, when you're using these technical analysis reports, and you see something on here, but you don't see it on your chart, then don't trade off it. Only trade off things that you see and you spot. Never trade just because a signal says buy here, sell here. You actually, as a trader, have to see it as well. Otherwise, you're trading blind. Okay, so let me give you another example. Let's have a little look at a popular pair and see what we've got here. Okay, sterling to US dollar. Intraday, remember this is a day trading signal, expect a rebound. So they have a preference to go long, to buy above 154.5 or 154.50. So we're looking at the charts. This is resembled with the blue line here. They are saying if the price returns to 154.50, then look to buy. And that's what that blue line is representing. So the blue line is effectively has the same characteristics as a support or resistance level. It's acting as a barrier to the price. And these green lines that you see here are ceilings, so they're resistance levels. This is the first resistance level, 155.70. And if the price manages to move through 155.70, the next resistance is 156. So it's very, very close. Whereas to the downside, the red lines here are what we call a support level. So there are floors in the price. And you see that the first floor is at 154. If that breaks, then the next floor is at 153.55. So this chart here is giving us some significant information about the price. Let's have a look to see if it matches what we're seeing. So you need to go to your sterling dollar chart. Let me just get rid of these indicators for the moment. So sterling US dollar, I'm just going to click on that price, drag it in here. Okay, so the signal is saying buy around 154.50. Well, if you look, this is actually the support zone we were looking at earlier, 154.55 to 154.60. So if the price comes back down to here, we have our own research that says, yes, there's support zone here, and we also have this saying that support is around 154.50. So obviously we'd be looking for an opportunity to buy as long as the price looked as though it was going to remain above it. Okay, so you've got the combination of your own analysis on the charts with these trading signals. Now, when you're trading off these signals and off your levels that you found on the chart, what you want to be looking to do is place your stop loss at a correct distance away as well. If you're trading, you don't want to be executing a trade and having your stop loss at an incredibly long distance away, because it means that you're risking more than you should be. So in this instance, if we were looking to buy in this zone, we would want our stop loss just below this zone. We wouldn't want it miles below. And if I go back to my example of dollar CAD, again, say we bought in this zone, we wouldn't want our stop loss 100 points below, because once this zone is broken, then the price can continue to move very quickly in that direction. Hence, we're risking more than we need to. Obviously, we don't want to be placing our stop loss just 10 points away, because volatility can knock us out. But at the same time, we don't want our stop loss miles away. Because one thing that you should be aware of these levels is obviously these levels will break at some point in the future. At some point, the price will move into a new range. Now, when there is a breakout, often the price moves very fast. So when the price does move through a level, the price moves very, very fast. And the reason for that is because all traders are doing the same thing, in the sense that they're all placing their stop losses just below this zone. So this is our support zone. It means that the market is very interested in buying at this level. But let's say there's some fundamental news that suggests that US dollar should get a lot weaker against the Canadian dollar. Or, huge orders are hitting the market at the same time, and it's causing this price to nip below 1.02. There will be a lot of stop losses resting in this zone below. Stop loss orders that have been put there to protect people that are in their trades. So, a dip below this can trigger all these stop losses at the same time, and hence the price moves extremely quickly in that direction, because everyone's trying to hit the market at the same time in the same direction. So it pushes the price in that direction. So you have to be aware that using these support and resistance levels and spotting turning points is a very good strategy, but there could be a breakout. And because there could be a breakout, you need to intelligently place your stop loss not miles away from where you've entered. Okay, so we've had a look at the technical analysis signals. If you need someone to go through these with you in more detail, then you can ask your account manager to provide you with a free training session. But what you're looking to do is combine these with your own analysis. There's also another section that's extremely useful on our website, which is a fairly new addition and one that's not easy to get hold of elsewhere. If you go back to the research analysis section, and bear in mind when you're actually logged in with your username, you can open more than one tab and it will keep you logged in. Now we're looking for this section called MNI, which stands for Market News International. Again, another professional third party. So you're getting the peace of mind that you're getting information from professional traders and professional technical analysis resources. Okay, so MMI, it gives you information from the trading floor. When you're at home trading by yourself, it's very hard to know what the crowd are doing. Remember I told you what each price represents? It represents a consensus of the market crowd. That explains to you that you should never trade just off your own opinion. Your opinion doesn't matter because it's the crowd consensus that's making the price move. So if you think the price is going to go up, but the crowd consensus is that the price is going to go down, then you're going to be wrong and you're going to make a bad trade. So whenever you're trading, you need information about the crowd, and this is what Market News International gives you here. It's giving you streaming news from trading floors around the world. It also gives you some more information about these support and resistance levels. Because we know that support and resistance levels can vary in strength, so we want to be looking at the strongest ones to trade off to make sure we have a higher probability of making a profit than trading at the support or resistance levels that's not going to hold. Okay, so you're getting a lot more information here. So I'll give you just a quick example looking at this. Euro versus yen. Strong cross supply presses to 99.30. So it's telling us that there's strong supply. European low is 99.16, which provides the support. So it's giving us a support in this pair. A break opens a deeper move towards 99.05. So if this low breaks, the price can move to 99.05 with stops set. Okay, and we've got some more information as well on cable, which cable stands for sterling versus US dollar. It's telling us that the pair remains buoyant around 155.40 and flirts with the intraday high. On the top side, technical resistance seen at 155.52. Okay, so it's giving us some information about the resistance level from the 76.4% retrace of 155.82. So we're getting some valuable information, and the good thing about this information is that, especially when there's activity in the market, it's updated every couple of minutes, and it will automatically update for us. Okay, so when we're trading, we're going to try and combine market news with the technical analysis with our own research as well. Now, some of you may be wondering, well, we haven't actually looked at any indicators yet. We're just looking at price pattern. Well, actually, when you're trading, the best way to trade is to keep it as simple as possible. And price patterns are the simplest way to spot a trend or a turning point. But obviously, you can use indicators as well. And I'm going to show you one simple indicator now to help you spot these turning points. Before I do that, I want to show you what not to do. There are many, many different indicators available to traders. If I go to my Insert Indicators here, you can see how many there are. And this is just a fraction of them. So it becomes very confusing. Now, if I decide to try and use several indicators at the same time, so I've just put on something called Bollinger Bands there. If I then put on let's see some other things. If I then put on what's called a MACD, Moving Average Convergence Divergence, and then I put something else on here as well, Relative Strength Index. Okay, so now I have many, many different indicators on one chart. This, in my opinion, is not the right way to trade, because I have 3 different indicators going on as well as the price pattern. And this can become extremely confusing. This can give me conflicting indicators of what to do. One might be telling me to sell while the next telling me to buy. So the best way to trade is to keep it as simple as possible and stick with using one indicator at a time. And bear in mind that these indicators have different roles. Some indicators help us spot a trend, whilst other indicators help us spot a turning point, or we could use one indicator but use it in 2 different ways. But you can't have one indicator for every single situation. So you as a trader have to be the one with the intelligence to know what's the market environment, what indicator should I use in this, where should I be getting my signals from. Okay, so the indicator that I want to show you today ties in with what I've been talking about, these turning points. Because these turning points are good points to trade, we can see that our risk is low because our stop loss order doesn't have to be too far away, but our profit potential is effectively very high when we do choose the correct turning point. Something you can use to support analysis of these turning points is an indicator called the Relative Strength Index. On this platform, you can find it by going to Insert, Indicators, Oscillators, Relative Strength Index, which is abbreviated to RSI. If I just place this on my chart, you'll see that a second chart appears below my main chart. The RSI is a mathematical formula that turns out a number between 0 and 100, a percentage. The mathematical formula in its simplest sense is looking at the last 24 candlesticks, because it's a RSI with a 24 period. We can alter this. We could choose it to be 14, which is a popular choice. In this case, it's looking at the last 24 candlesticks and telling us what percentage of them have been moving up, what percentage of them has closed higher, and it gives us a result. If the RSI was at 100, then it would mean that the last 24 candlesticks have closed higher. If the RSI was at 0, then it would mean that the last 24 candlesticks have closed lower. If it was at 50, halfway point, it would mean that obviously 12 of those candlesticks closed higher, the other 12 closed lower, in whatever order. Okay, I'm going to change the RSI to 14 periods, since this is a popular, the most common choice for the RSI. Okay, and have this on my chart. Okay, so you can see here that the RSI is moving nicely with the price. When the price moves higher, so does the RSI. When the price moves lower, so does the RSI. I'm just going to go to my 15-minute chart now. Again, we have this RSI. Okay, so previously we identified the support level in this pair, sterling dollar. Look at 154.60 here, down to 154.55 low. Let's see what's happening with the RSI whilst these lows were occurring. First low, you can see the RSI has just dipped before a low here before retracing back up, as the price did. Okay, the next time the RSI comes to a low again, but it's not quite as low as it was before. This is actually giving us a signal. Just get rid of these two vertical lines. Okay, so let's focus on this signal. I've shown you here, the sterling to US dollar comes to a new low. The RSI also comes to a new low. We have no signal at this point. The price then comes back higher again. Comes back to this low. The RSI comes lower again, but not as low as it did before. And I'm going to mark that in. So this is our previous low. This is coming back to the low, but the RSI is much higher. This is what we call a signal to buy. It's what we call bullish divergence. A divergence, a difference in between what's happening with the price and what's happening on the RSI chart. The price is low and comes back to this low. The RSI creates a new low, but it does not come back to the low like the price is doing. An indicator to buy, so it's an indicator that this could happen. Then we have the situation again where the price comes back down, and this time it moves even lower than it did before. So now we're going to compare this low to this low. The price has moved to a new low, but what is the RSI doing? The RSI does not come back to that previous low. This is an indicator to buy. So you can see on two occasions here, first of all with this one, and then next and more obviously with this one, we've got our indicator to buy. This is bullish divergence. The price has come to a new low, but the RSI is higher than where it was before, an indicator that the price has run out of momentum to move even lower, also combined with the fact that this is our support zone that we've identified before, and combined with the fact that our technical analysis is also telling us that this is a significant level to buy at. The combination of all three give us this indicator to buy. So we've been told this is a strong level to buy at. So it's fairly simple. Okay, let me see if I can find you the opposite example. So something that's happening on the top side. Now, you can see that this climb, which happened late last week, to the highs. The first high was created here around 155.67. Another high was then created here, 155.72. Another high here, 155.82. Okay, so we've got 1, 2, 3, 4, 5 numerous tests on this high from around 155.67 to 155.82. Fairly small area of resistance, which is about 15 pips. That we can see over a period of time, the price keeps on trying to test this level. The market are trying to bump the price up above it, but it's running out of steam. Buyers, people are not happy to buy at a higher price. But how can we actually use this in our trading combined with the RSI? Let's have a look to see what was going on in the RSI at this time. We can see that the first time the price peaked at this level, the RSI created this high. And you can see as the tests continue, the RSI doesn't have the momentum and doesn't match the price pattern we're seeing. So the price is testing this high, which is our area of resistance that we've identified, and possibly it would have occurred here as well, where you see 155.70 to 156 is a resistance on our current trading signal. And our final signal to give us that indication that we're going to go in and sell is the fact that we're getting a divergence, a difference between what is happening in the price and what is happening in the RSI. The price is saying that the price of sterling dollar is coming up and testing this, but the RSI is saying I'm in a downtrend. The peaks of the RSI are not as high as before, hence an indication to sell. So this will be our last signal to give us the green light to go ahead and place a trade. Okay, so perhaps you would have chosen to sell here or here. At any of these points, you would have sold in this zone and you would have placed your stop loss above this level. And you can see it would have made a nice trade. Now some of you may be saying, well, how do I know when to get out? If I have sold up here, how do I know when to close my position? Well, whenever you're trading, you should always be thinking that you want to be risking less, or certainly no more than the amount you're looking to gain. Hence, your risk amount is either going to be the same as or less than what you're looking to profit. So if in this situation, if I'd sold at 155.70, for example, and I was prepared to risk 30 pips, I put my stop loss around 156, then I have to be prepared to make at least 30 pips as well. So my take profit should be at least 155.40. Now in terms of knowing where I should get out, you would be looking again at the same way you look for entrance points, you look for exit points. Okay, so we can see here that previously the price was struggling to move through 155.20. So possibly we'd be looking to get out around there. But also we can combine this with what is happening with the RSI. We could see that actually the RSI was still holding some momentum down here. It was still in a downtrend. Even at this peak here, this peak was lower than that peak. So we could have had the confidence to hold on to this down to where the RSI began to flatten. And if we are in a position where we're making a nice profit, the great thing that we can do is actually draw our stop loss down to trap in the profit. So let me just print this as an example on the chart. Let's say we'd sold somewhere around here, halfway in between our resistance zone. And we've put our stop loss somewhere up here at near 156. But now the price has got down to here. So the live price is now around this level. We sold here, so effectively this is our profit between where we sold and where the live price is. Our stop loss is still up here, protecting our maximum risk. What we can do in this great situation is that we can actually move our stop loss closer to the live price, which means we're actually trapping in profit that we've made already, but still allowing room because we believe that the live price may come even lower. Okay, so if you're in a position where you're in a profit, but you have facts in front of you, like the RSI being in a downtrend to suggest that the price is going to continue going in your direction, then you can consider, rather than closing your trade, but trapping in a portion of your profits using your stop loss, which is a great situation to be in because you know that you've made money on that trade and you know that there's a potential to make more. But if the potential changes, then it's okay because you've actually trapped in that portion already. Okay, I'm going to give you a couple more RSI examples because, like I said before, I think the best way to learn is through examples. If any of you have any questions, please don't hesitate to type them in the box. Okay, actually there's one question before I go ahead, is that the RSI can be difficult to look at, and this is absolutely right. In fact, a lot of these indicators can be difficult to follow at what we call the hard edge of the price. So when the price is actually happening. Yes, it's very easy for me to go back in time and find examples that have worked. As anyone that presents technical analysis indicators, it is very easy for us to do that. Now, what you have to remember is that any indicator you're using is never going to be 100% correct. So you have to accept that sometimes these indicators are not going to give you the right signal. This is the reason why we use our stop loss correctly, and we always make sure that we're not risking too much. And secondly, we always make sure that our risk is never larger than the amount we're looking to profit, because it means that over time, down to probability, we're going to be up on our trades rather than down. Now, the best way with the RSI is actually to wait either for that candlestick to, if you're looking, for example, we're looking at the 15-minute candlestick chart at the moment, is wait for the 15-minute to close and then see what's happening with the RSI. You want to wait for that tick in the other direction before you actually enter. So, for example, with this particular one here that I can see on the sterling dollar, and the one that we were talking about before, the price has come to this low and moved back up again. Okay, then the price has come to an even lower low. Okay, and we can see that the RSI didn't come as low. So that's the example I gave you before, which is the bullish divergence, the signal to buy, which also nicely fits in again with that support that we identified here. Okay, so let me just chuck that support in down there for you. Okay, so what would we have done if we had been looking at this at the time? Well, the person that asked me the question is absolutely right. We wouldn't have been able to enter at exactly this point. based on the RSI, possibly based on the fact that we know it's a support level and we can see that the price is becoming congested here and the market don't look to take this through any further. But if we were just using the RSI signal, you can see it's very difficult at the hard edge of the price, of the live price, to decide whether to go in or not. What you can do is wait for this bar to close. So you can see in this instance it's closed higher. So have the patience to wait for it to close and see that this RSI chart has ticked up. So you're waiting for that tick up before you enter. You still, in this situation, you can see that you still had good potential to make profit, whilst your downside risk was still smaller than your profit potential. So yes, every single time you enter a trade, you have to think about what is the probability of me profiting from this situation. And you're always wanting to increase your probability. And one of the ways you can do that is making sure that your risk is never ever more than your profit potential. Now I can tell you that actually on a trading account, over the course of several weeks, I tried the RSI bullish-bearish divergence. This is all I did on this account, and I collected it in a trading diary, and I could see that over time the signal was right more than it was wrong. But obviously every trade is different, and every trader is going to be looking at the charts differently. So one method you can use to actually train yourself and train your mind to do this properly and iron out your mistakes while focusing on what you're doing right is to actually use a trader's diary. And if any of you need a template of this diary, I can send it to you and you can work on it. And in fact, whenever you are using a new signal, just to do personal training, and also so you can transparently see what is working and what's not working, you should always choose to put the signal on a trader's diary over the course of a couple of weeks. So you're refining your strategy. Okay, a couple more examples and then I call it a day. So let us look at dollar CAD, or sorry, euro dollar. Let's have a look at euro dollar first. I'm looking at a 30-minute now. So this is a 30-minute candlestick chart. Just get rid of these lines. So we just got a clear sheet to start with. So I've got my euro dollar chart here, and I've got my RSI here. Okay, so let's have a look. We're looking at last week, 7th of June. The high on the 7th of June took the price to 26.24, around that area. You can see the RSI also posted a new high at that point, moving higher from where it was previously. Price came down. Price came back up again, not quite at the high, but almost there. You can see the RSI was a lot lower. This is giving us some indication of bearish divergence, where the RSI is in a downtrend, and it's supporting our idea to sell at this point. Okay, one more example. This is the Australian to US dollar again, the example that I started with today. Again, looking at 15-minute. I'm looking at the 15-minute and 30-minute just because they can be quite good time frames to look for those of you that want to day trade. Like I said before, day trading is good for those that want to take on small amounts of risk and just look to make profits through small moves in the market. And obviously looking at 15 or 30-minute is just giving me the most recent moves in price. Okay, so this is the Aussie to US dollar. If I go back to Friday again, end of last week, the price came to this low point. Now, if you see here, the price actually became fairly congested. When the price is congested, it either means that there's nothing going on in the market, so the market's just extremely quiet, traders are not trading, or it can mean that the market is busy and there's traders out there, but people are very undecided on the direction that they're going to take this pair. So price congestion can be an indication of this undecidedness. And if we're looking at this here and comparing it to what's happening with the RSI, you can see that the RSI begins to turn up. And it's making it a lot more obvious than just looking at the price. You can see that we've got a low here, a low here, a low here, and it's moving along this low, but you can see by this point the RSI is now beginning to pick up, an indication to buy. Okay, so I'm going to round things up now. If there's any more last-minute questions, then please fire them off to me now. Like I said, if you're not watching the live webinar, you can send questions to uktraining@easy-forex.com. I've got someone here that's asking where can they get the trading diary template from. You can email that request to uktraining@easy-forex.com and we will get that template for you. Now, obviously, when you're trading, there are many, many different indicators that you can use. In today's session, I have focused on one particular indicator because it links nicely with support and resistance levels. But there are other indicators that can indicate trends, so you can look to find when the trend is at its strongest and when you should follow it. So this was turning points today, but if you do need any other information, your account manager can be there to provide you with information on these indicators, and they can educate you on how to use them. Remember I showed you what not to do? Do not chuck a million indicators on one chart. It's just not going to help you at all. If you do want to trade with more than one indicator, for example, I've proven to you that the RSI is good for turning points, but the MACD, MACD, moving average convergence divergence, can be good for a signal that a trend is about to take hold. Then I would choose to split them onto different charts. So here's our Aussie dollar with the RSI. And then we can have another Aussie dollar chart. But this time we choose to put the moving average convergence divergence on there. Okay, so actually splitting our analysis up. It's the same when you're looking at time periods. If you're looking at a daily candlestick chart and you found a signal on there using an indicator, but then you go to trade off of the 15-minute time period, then that's not the correct way to trade. You have to stick in the same time period. If you get your signal to trade in one time period, then stick to that time period as an indication of where you should be looking to get out, because the ranges are different in different time periods. Now, also the last things that I should leave you with is that the resistance and support levels do vary in strength, and I've told you that you can get the breakout, which means that the price moves very, very fast when that level does actually break, so you have to factor that in. And they vary in strength, so when you are looking at a support or resistance level, it doesn't mean you necessarily have to trade. You want to look to trade off of the strongest ones. If you find a support or resistance on a day chart, or a longer time frame, it means there's more significant in that level. Of course, you can then come down to a smaller time frame and analyze that level on a smaller time frame for you to trade off your day trading. If a level has been tested more than once, that also means that it's more significant. So if we see that we've got a significant high, for example, that I show you in Aussie dollar when it reached 1 and shot back down again, that's our significant high. That's what may form a resistance. And then when the price comes back up to 1 and comes down again, now we have our 2 points resistance level, we can draw the line through it. That has more significance because the price has been tested twice. It means that twice it's proven to hold. But as time goes on, so you'll notice that as a resistance level, any level gets tested time and time again, it can become weaker. So you also have to factor that in. And you'll see, because if the resistance levels begins to get weaker, you'll see that the price is becoming more challenging on that level. So you'll see at the price that the highs spike through it. Okay, so you can spot that when you're analyzing your charts. Okay, so someone's asking me if there's a handbook that explains all of the indicators and where can I find it. To be honest, you wouldn't want to know every single indicator out there. You need to find the ones that are good for you. And like I said, you have to keep it as straightforward as possible. There are handbooks that do give these indicators, but to be honest, it's going to be way too much information for you. I can actually send you a presentation with a few different indicators that you can look at and practice yourself in your own strategy, and like I said, employ the trader's diary as well. Okay, so if you email uktraining@easy-forex.com, or you can email me directly at zoe@easy-forex.com, that's ZOE at easy-forex.com, then I will send you a presentation with some indicators in. And also your account manager will provide you this in your training. So I've got two more questions and then I do have to go. Someone's asking me about the New York close on the charts. Okay, now the close on the charts, if you're looking at your daily candlestick charts, that I believe is going from midnight to midnight. Yeah, midnight GMT to the following midnight GMT. So the candle charts aren't giving the New York close. If you want to actually identify that, you can actually go to your daily charts, your hourly candlestick chart, and if you know what hour the New York close is, I think it's 9 o'clock our time, then you can actually go to that candle and hover your mouse over the top of it, and you should see at the bottom. So when I hover my mouse at the top here, if you take your eyes down to the bottom of the screen now, you can see it's giving you the time and the date, the open and the close, the low and the high as well. O open, H high, L low, C close. So you're getting all the information about that candlestick. Okay, so this webinar has been recorded and you will receive the recording in a link which will come to your email in 3 hours' time. And for those of you that haven't participated in today's live webinar, don't forget you can ask us questions by the emails that I've given you.